So when we're dealing with stock, we are looking at the owners of the limited companies who are called stock holders or shareholders. We have two types of shareholders. We have the preference shareholders and the ordinary shareholders. The preference shareholders own what is called preferred stock. Now, this preferred stock is a type of stock that usually promises a fixed dividend. Now, a dividend is simply a return that is earned on a share. And this one, at the discretion of the board of directors, these ones are given preference over the common stockholders, are given first. Of course, we have two types of preference shareholders. We have what we call the cumulative and the non-cumulative. The cumulative are the ones who would still claim for their forfeited shares in a bad year, forfeited dividends in a bad year. And the non-cumulative do not do so. So valuation of preferred stock is simply given by the dividend paid over the market rate or the appropriate discount rate. So an example we could have is a stock issued at $100 per value, having a discount rate of 10%, has a fixed payment of 8%. So these are preferred stockholders who are given a fixed dividend. So their payment is 8% of 100, which is $8. The dividend paid is $8. Then you divide it by the appropriate discount rate. So it's one of the easiest, less examined types of valuations. So the dividend paid over the appropriate discount rate. So we are told that an 8% preference share holders has a market rate of 10%. So 8% of this par value is 8 kwacha. We divide it by the appropriate discount rate, which is 10%. So the dividend paid for the preference shareholder is 8 kwacha. So we assume that this is held to perpetuity. Now, where the interesting position comes when we're dealing with the common stock. The common stock represents the residue of ownership. This means that after everyone else has been paid, they now deal with the remainder. The remainder is a residue which goes to the ordinary shareholders. Any questions so far? Okay, so if we've gotten that, we must also understand that common stockholders are paid on what is called a pro rata basis, meaning their earnings are given after other obligations of the firm are met. So the dividends may be paid out on this proportion basis of their earnings. So common stock represents the interest of the ownership of the company. These are the real owners of the business and are entitled to decision-making because they own what are called voting rights. Now, these shares also entitle the shareholders to dividends, but they're not guaranteed that they'll always be paid a dividend because in a bad year, they'll forfeit their dividends. So the shares in such kind of a structure can also be sold at a future date at a higher price when the stock prices go up. So this will allow the shareholder to earn what are called capital gains. which have their own computations. So it is also possible to make a loss on those shares if the shares depreciate. So the main cash inflows for these kind of shareholders is through capital gains, the dividends that are paid. And that's the reason why the shareholders and the managers are usually antagonistic. The managers want to plow back their retained earnings because they know that is the freest form of source of funds for a company. Whereas the shareholders want a dividend to be declared for them because that's where their main cash flow streams emanate. So we're going to look at 3 models. We'll look at what is called the growth model. We'll look at what is called the Gordon's model. We'll also look at the CAPM model in computation of stock. So common stock, we're going to use a time value of money using the future dividends. So the language we're going to now acclimatize to is the dividend paid now. It's D0. Dividend paid after 1 year is D1. Dividend paid after 2 years is D2. So using the future value formula, which we know that future value is equal to present value, 1 plus R to the power time. We're going to use the dividend. Dividend 1 is equal to dividend 0, 1 plus growth to the power n. So the n is the difference in the years here, so the power 1. If the difference is 1, if we're going to use D2 based on the first year, the power here will be D to the power 2. We're going to use D3 against D0, the power will be power 3. But again, you can have D4 against D3, and the difference in the power is 1. So this is the power 1. So the key thing is to understand the projection. So if we're dealing with dividend now that has been declared at 10 kwacha with a growth rate of 8%, how do we calculate the dividend year 1? So this is 10 kwacha, 1 plus growth to the power 1. The growth rate is 10%. So this is 10 plus 1.08 to the power 1, which is 10.8. In growth in year 2 will simply be 1.08 to the power 2. So what we're going to get, 1.08 times 10 will give you 11.66. Alternatively, you can just multiply this one times 1.08 to get the next dividend. So 10.8 times 1.08, which is our growth rate, will still give you the same answer. So D3 will be what? D0, 1 plus growth to the power 3. So this will be 10, 1.08 to the power 3. So that's what will give us 12.6 or 59. So I said alternatively, the projection from 1 year to the other, just multiply by 1 plus R. That's what we do. It's like an annuity due. So this we just multiply by 1.08 just to get the next figure. I'm just trying to teach you important shortcuts if you're behind time. 10.66 times 1.08 is the same thing, which is 12.59 or 12.50. Now, suppose from year 4, from year 3 to year 4, our growth rate has changed. Instead of we're using the 8%, it drops maybe to 6%. That's why I'm telling you it's important to understand the projection. So we're going to multiply this one by what? 1.06 to get the dividend for year what? For year 4. Or alternatively, let's say D3, 1 plus growth to the power 1. So this is our D3 is what? 4.60 and 1.06 the power 1. The answer we're going to get here is simply the same as 4.60 just multiplied by 1.06. It's the same thing here that I just did. Okay, I hope you're following me closely. So this is what we call the growth model. It helps us project figures when we're given a specific period of time. So we also have what is called Gordon's model, which helps us calculate our value of the dividends if we are given a constant growth, which increases at a constant rate thereafter or forever. It is simply D1 over K minus G. So we know that D1 is the same as D0, 1 plus growth, K minus G. We know K is what? The discount rate, G is the growth rate. So if we are told that the dividend declared now is 10 kwacha, and the growth rate is 8%, and the market rate is maybe 15%, and we're told that this kind of stock is growing at constant growth forever. So using Gordon's model, the value of stock now is simply what? D1 over K minus G. And our D1 is simply D0, 1 plus G over K minus G. So in this case, 10 kwacha, 1.08 over 15% minus 8%. So this will give us 10.8 over 15% minus 8%, which is 7%, which is 0.07. 10.8 divided by the answer. The value of stock will be 154. So I've combined two theories here, the constant growth model and the Gordon's model. So an examiner will now bring a question to say, suppose we have what? Declare the dividend now, which is 10 kwacha, which will grow for 3 years at what? 8%. Then this will drop to maybe 6% thereafter, after the 3rd year. Then we're also told that the market rate is 15%. So calculate the value of stock now. So we can use a number line. So we're going to use two phases. All right, 0, 1, 2, 3. So this 10 kwacha, what does it grow to year 1, year 2, year 3? And what dividend will you have in year 4? So using the constant growth model, we're going to predict the dividend in year 1, dividend in year 2, dividend in year 3. Take note that from year 3 upwards there, the growth rate drops to 6%. So we do what we're doing here. So what is our dividend for year 1? We use 1.08 to the power 1. So this will give us 10.8. So this is where the 10.8, I don't want to recalculate what I've already done. So here, this is 10.8. And we get D2, we still use the same formula, 1 plus growth. The power 2 here, we get 11.66. So here we're going to have 11.66. And for year 3, we calculate this 12.60. So we're going to put 12.60. Now for year 4, we cannot use that formula, but we just multiply this because the growth rate has changed. So we simply multiply this one by 1.06. So the D4 here would therefore be what? 1.06 to give us 13.36. So this is where 13.36 comes from. Now, this is in phase 1, and this is in phase 2. So we need to calculate the value of stock for each of these ones. So we discount these figures to know how much they're worth today. So we use the market rate to calculate the worth of these values today. So D1 is 10.8. So D1 is 10.8. Calculate the value of stock today. It will be 10.8 times what? 1 plus KD to the power negative n. Since it's in year 1, we're simply going to say 10.8, which is 1.15 to the power negative 1. Okay. So this one will discount this figure to 9.39. In the D2, we found what? The D2 was 11.66. So 11.66 will discount it by multiplying 1.15 to the power negative 2. Since it's near 2, this one will give us 11.66 times 1.15 power negative 2 will be 8.82. And D3, which we calculated as what? 12.60 in year 3. 12.60 in year 3, we'll discount it using the market rate. It will go to 12.60 times 1.15 to the power negative 3 will give us 8.28. So 9.39 plus 8.82 plus 8.28 will give us 26.49. So this is the value of stock from 1P3. So discounting these for 3 under phase 1, the value of stock here is what? 26.49. 26.49. Now, value of stock in phase 2, we'll now use the Gordon method. So if this is our year 0, this is our year 1. So we're going to calculate using Gordon's model. We know that value of stock now is equal to D1 over K minus what? K minus G. All right. So our V1 is as good as what? 13.36. Or if you want, you can see D0, 1 plus growth over K minus G. It will still give us the same thing. So it means we recalculate our 13.36, which was what? Which was 12.60 plus 1. Then the growth rate has dropped from 8% to 6%. So 12.60. So this will be 12.60. 1 plus growth 1.08. Not 0.8 this time, but 0 what? 0.6. And we have 15% here. And also we have what? 6% here. So this will simply take us to the same D1, A minus G. So this D1 in this case now will be 13.36, which we're going to have here, 13.36. The market rate, 15 minus 6% is 7%, which we calculated 13.36 divided by 7%. Okay. So this will give us what? 13.36 divided by 7%, which will be 190.86. Now, this is the value of stock as at year 3, because our V0 is at this point here. So at this point, we're going to have 190.86. So we need to calculate this value to now. So we need to discount it 3 years backward. The way we're doing with these figures are to calculate the value of stock now. So this now makes us multiply this one by 1.15 to the power -3. So times 1.15 to the power -3. So meaning the value of stock for phase 2 will be 125.49. 125.49. So what does this mean? The sum total of the value of stock will be the phase 1 value of stock and phase 2 value of stock. So 26.49. So value of stock today, 26.49 plus 125.49. So the final answer we get is 151.98. So this is the value of stock today. So this is the second toughest when we're coming to the topics in stock valuation. Homework is the toughest. So this is the growth model. Let's look at the example from our books or our notes. So we're told the company has a required rate of return, which is 16%. Okay. Then we're told that the growth rate for the first phase is 30% for the first 3 years, and it drops to 10% thereafter. The dividend now is 1.82. So we're going to use the first and the second phases. So the first, we find the future values for these D1, D2, and D3, the way I explained them. So D1 is 1.82. The growth rate is 30% to the power 1. 1.82, 30% to the power 2. 1.82, 30% to the power 3. So these are the 3 growths. Then we discount them by multiplying. What is our market rate? We're told that the market rate is what? 16%. So we can either use the tables or the manual calculation that I was telling you. So 16% is 1.16 to the power -1. But if you check this in the table, 16% under 1, it will be 0.8621. When you discount this figure, it will be 2.040. Again, you discount this one, 3076 times 1.16 to the power -2. And check this in the present value factor to give you 0.722. Multiply by that one. This will give you 2286. Same, 1.16 to the power -3. And discount this one, it will give you 2562. Then when you add all these, you get our value of stock for phase 1. Are you following me closely? Are you following me closely?
Yes, we're following.
All right. This is very technical, you need to understand. Then we now understand that phase 1, the value of stock is what? 6.888. So now to find the value of stock for D4, I say the easiest way because we know that it dropped from what? From 30% to 10%. The answer that we got here, just multiply by 1.10 to get the value of D4. Then you use Gordon's model. So D4 will just multiply 399 times 1.10 to the power 1. Then we divide this one, K minus G. Our K is what? 16%. And our new G is what? 10%. So 6% is the difference between these two. So meaning we're going to do D1 over 6%. So this is whole O, D1, D0, 1 plus G. This is D1, and 6% is the difference between 16% and 6%. So we get what? 73. Now this 73 is a price of stock as of year 3, because this will be your D0. So this is your D1, D0. So at this point here, 73 is your price of stock. But we want the price of stock discounted to now. So meaning we're going to multiply this one by 1.16 to the power minus 3. So we're going to do this. You're using the present value factor, you find 6407. You multiply by that, we get 46 as a price. Now we're going to add this guy for phase 2 and the guy for phase 1 here. Find the total value of stock, so which is 6.888 and 46.98, and this will be 53.87. So this represents the value of stock when today. This represents the value of stock today. Interesting. So yesterday's test that your friends were writing, I'll need you to capture and try this question. Right, question 3. You do both A and B, 10 marks each. So just to give you an idea, the company's required rate of return is 16%. It is expected to grow at 6% for 3 years, then it will drop to 4% thereafter. It is recommended that the value of stock last paid was what? 2 kwacha per share. So what have we been given in here? Some, identify the parameters.
We've been given the growth rate for the first phase, which is 6%, and the growth rate for the second phase, which is 4%.
So G1 is 4%, correct? G2 is what? G1 is 6%, and G2?
G1 is 6%, G2 is 4%.
4%. What else are we given?
I've forgotten what we call the 16%. I've forgotten what it's called.
KD, which is a market rate. Okay.
The market rate, yes.
So what is the job for the G1? To give us a constant growth for D1, D2, and what? D3. By multiplying the 2 kwacha, 1.06 to the power 1. 2 kwacha, 1.06 to the power 2. 2 kwacha, 1.06 to the power 3. Then what do we do to these figures when we get the values here? W, X, Y, what do we do them? We discount them, right?
We discount them.
Using
Yes.
the market rate, 1.1 power 1, negative. 1.16 to the power 2, negative. 1.16 to the power 3, negative. So the values A, B, C, when we add them, that would be what? The value of stock for what? Phase 1. Is that clear?
Yes.
Then how do we find D4? The D3, we multiply by 1 point what? 0.6 or 0.4?
0.4.
Good, 0.4. In our imagination, this is as good as D1. Then K minus G. What is our G that we're using in phase 2 now?
4.
Good, 4. So 16% minus 4%, which is 12%. So the value that we're going to get here, Z, is a price as of year 3, is our Z. What do we do to this Z?
We discount it.
We discount it 3 years backwards. All right? So that it gives us a value of stock as of year 0. So if we get our answer as E. So the total value of stock is the D we found for the first phase and the E we found for the second phase. So D plus E will give us what? The value of stock today. Is that clear?
Yeah. Is this an exam question?
Yes, an exam question. And I trust that you do a good job for part A and part B.
Part A is what you did yesterday, and part B
Yes.
is okay. Yeah, I'm sure we can.
All right. Thank you so much for your time. We'll meet on Sunday. So please review the videos and we can now start preparing for exams. So our next lesson will be cost of capital. I did risk and return already. If those who missed it, I think I can redo it. And dividend policy, and we are done with the syllabus. And we start going through all the tests. And we also did capital budgeting already. Those that are starting on Sunday, please, you're starting from topic 1, time value of money. And for the rest of you, I think I've covered almost everything. Thank you so much and have a good day.